What's up, value hunters? Dave here, and today we're diving deep into a consumer staple giant, Procter Gamble, ticker PG. This stock has been taking a beating lately, leaving many of you wondering, is the bottom end for PG? We've done the hard work, crunched the numbers, and looked at the charts, so let's get into it. All right, let's kick things off with the big picture. The chatter around PG right now is all about cautious U.S. consumer sentiment. P&G's CFO, Andre Schulten, recently dropped a bombshell, warning that U.S. consumers are nervous and cautious, pointing to concerns like potential tariffs, government shutdowns, and general economic jitters. We've seen reports that sales volumes and values were down significantly in October, with November not looking much better. This has fueled investor anxiety about demand for big brands like Tide, Pampers, and Gillette, leading to recent analyst downgrades and the stock underperforming both the broader market and its consumer staple peers. Shares have actually hit multi-year lows, trading near their weakest level since March 2023. Now, for those of you who might not know, the Procter & Gamble company is an absolute behemoth in consumer packaged goods. We're talking about a global powerhouse behind brands you probably use every day: Head & Shoulders and Pantene for your hair, Gillette for your shave, Crest and Oral-B for your teeth, Tide for your laundry, Pampers for the little ones, and Charmin for, well, you know. They sell their products everywhere from your local grocery store to e-commerce giants. When we look at their official numbers, P&G's Q1 fiscal 26 results, ending September 25th, actually showed some resilience with 2% organic sales growth. They managed this primarily through pricing, which offset flat volumes, and they reiterated their commitment to core EPS growth. But that subsequent warning from the CFO about declining volumes in October and November is the real red flag, suggesting a potential shift in their current quarter. So, how do we reconcile P&G's official Q1 resilience with the CFO's later warning and the market's nervous reaction? That's where our multi-scenario analysis comes in, giving us a roadmap for what could happen next. First, let's talk about our base case, which I'm giving a 40% probability. In this scenario, we assume that while the difficult consumer environment persists, P&G's incredible brand strength, pricing power, and international growth, like that solid 5% growth in Greater China, will allow them to stabilize. Volumes will likely remain flat, and pushing further price increases will be tougher. This leads to modest EPS growth, below historical trends, but still positive. For the valuation, starting with current EPS at $6.85, we project a modest 3% growth for FY26 to $7.05. Then, applying a conservative PE multiple of 20x, reflecting current market conditions for defensive stocks, we get a fair value of $141.11. I've weighted this at 40%, but I have to say, the technical analysis, showing a multi-week downtrend and a break below major support at $142, really moderates my confidence in an immediate stabilization at these levels. It tells us that current market weakness is likely more dominant than the underlying fundamentals alone. Now for the bull case. I'm only giving this a 15% shot, and there's a good reason for that, which I'll get to in a moment. This scenario assumes that the nervous and cautious consumer sentiment proves temporary or less severe than feared. P&G's brand strength, innovation, and marketing kick in, helping them regain volume momentum faster than expected, especially in North America. International markets keep growing strong, inflation cools, boosting confidence, and analysts re-rate PG as a resilient defensive play. Management even exceeds its targets. For the numbers, we take the current EPS of $6.85, project stronger 5.5% growth for FY26 to $7.2217, and then apply a higher PE of 22x, reflecting improved sentiment, giving us a fair value of $158.88. Now, why only 15% probability? Because our technical analysis strongly weighs against this. It clearly states PG needs to maintain above $157 to resume an uptrend, which is significantly above current levels. And the recent break below 142 support further diminishes the likelihood of an imminent bullish reversal. It's just not what the chart is telling us right now. Finally, the bear case, which I'm weighting at 45%, this is the one we need to pay close attention to. Here, we assume that the nervous and cautious U.S. consumer sentiment deepens, leading to sustained declines in sales volumes across key categories. A deteriorating economic environment forces consumers to aggressively trade down to private labels, crushing PG's pricing power. Analyst downgrades continue, and the stock re-rates lower as its defensive qualities are questioned. Management misses guidance. Valuation-wise, from $6.85 current EPS, we project a significant 5% decline for FY26, bringing us to $6.57. Then, applying a lower PE of 18x, reflecting severe headwinds, we get a fair value of $117.14. I'm giving this scenario the highest probability, 45%, and frankly, the usual analysis strongly supports this pessimistic outlook. PG is in a multi-week downtrend and has just broken below a major support of $142. This technical breakdown confirms strong selling pressure and increases the probability of further downside, aligning perfectly with a more severe fundamental deterioration. All right, let's pull up the chart for Procter & Gamble and see what the technicals are telling us. And right now, it's not looking pretty. PG is clearly in a multi-week downtrend. Here's the kicker. The stock has just broken below a major support level at $142. That's a significant move, folks. Looking ahead, the next key support levels we need to watch are down at 128 and then 120. If you're hoping for an uptrend, for PG to really turn things around, it needs to get back and maintain above 157. Until then, the path of least resistance looks to be downwards. So, is the bottom in for Procter & Gamble? Based on our deep dive, the short answer is no, not yet. The market narrative, fueled by management's own warnings about cautious consumers, combined with the clear technical breakdown we've seen on the chart, points to elevated downside risk. Our scenario analysis, particularly the higher probability we've assigned to the bear case and the challenging technical picture for the bull case, suggests that PG has further to fall before finding a true bottom. Given our analysis, and with the stock trading around $143.45 as of December 5th, I wouldn't be looking to jump in here. Based on our bear case fair value of $117.14 and the technical support levels at 128 and 120, those would be the areas of interest if you're looking for potential entry points. Keep an eye on the 128 mark, and if it breaks, then 120 comes into play as a stronger possibility for accumulation. All right, value hunters, that's our take on PG. If you found this analysis helpful, do me a favor, smash that like button, subscribe to the channel for more deep dives, and drop a comment below. What do you think about P&G? Is the CFO being overly cautious, or is a consumer recession truly on the horizon? Remember, this is not financial advice. I am not a financial advisor. All information presented here is for educational and entertainment purposes only. Investing in the stock market involves risk, and you could lose money. Always do your own research and consult with a qualified financial professional before making any investment decisions.